Hey, Simple Passive Cashflow listeners. Today we are going to do a coaching call today, and you guys are going to be able to listen in. We are changing the identity slightly to protect the innocent, but Patrick's here, and he is also an engineer, if you can tell by the gaming headset that we all like to have. How's it going, Patrick? Thanks for doing this again.
Thanks for having me, Lane. It's great to be here.
Yeah, so you volunteered putting up sort of a pseudo personal financial sheet here, PFS as we call. Kind of introduce yourself and kind of take us from the beginning. Maybe where you are in your career too.
Okay, gotcha. So I work in IT as a government contractor. Um, Recently started making money that had me above and beyond just the normal necessities. So I was able to start putting some money away. And then just, as career progressed and everything like that, I realized that, I like the job, I like the industry, but it's not where I see myself being for the next 40 years. It's just, chained to a cubicle. Um, that's not really appealing. I've seen a lot of people go through that, and it's just not something that I can see myself doing or being interested in for the long term. So with this extra money, I started listening to podcasts like yours and a couple other people in the similar spheres. Um, Started looking at real estate, started looking at Turnkey, started looking at AHP back when they were AHP rather than AHP servicing. Just anything that I could find to, as you term it, reach escape velocity in terms of keeping your expenses low and then ramping up to be able to get where you need to go in terms of the various stages of financial freedom. So I've got the monthly savings just from the W-2 job kind of down to the quick, where I think I'm not sure how much further we can go with that before we start, doing rice and beans 24/7 or just eating ramen all the
Yeah.
time. But um, what I'm interested in and looking for now is kind of a way forward. I don't have mass to use a physics equation. I don't have money mass or financial mass, but I have decent velocity in terms of accrual. I've got a turnkey property down in Memphis. I'm probably going to close on a second one in the next month or so. My brother and I bought a property up in Harrisburg to rehab and do ourselves, and I've learned enough from that experience to know that I do not want to do that again. Um, so I just want to be more on the passive side going forward, not swinging a hammer.
Yeah, so I'll kind of reiterate what you mean by mass, and mass is usually
Yeah.
what's termed as a combination between your net worth, which is about 160,000 now, and also how much money you're able to generate from your W-2 job. Maybe we'll kind of go over that real quick, just so people get a sense. When did you graduate? When did you start working?
So that I actually worked my way through college to keep the debt as low as possible. So it took me 7 years to graduate. I think I got out of there in 2013.
Okay, and then starting salary was
Down here was 65, and I've bumped it up just by trading up essentially to 170.
yeah. So this is kind of the classic first generation wealth story, right? You don't have very much net worth or like we said, mass, but you're making a pretty good salary, and luckily you're used to the beans and rice, as you said.
Yeah.
So it kind of, and this personal financial sheet, that's what we're looking at here is the bottom left quarter. That's how much money you're making, and then the upper right hand quarter, which is your liabilities. And so if you're making about 170 a year, how much of that are you spending? What's your rent like, or your mortgage like, and then how much are you able to save about per year?
Right. So I've actually done it in terms of month. My monthly mortgage here is 18-ish, 18 even. That's, all taxes, HOA is rolled in there,
All right, and that's not
insurance.
extravagant at all for that area.
No, unfortunately. Yeah, Northern Virginia. I mean, you can crack 2,500 without breaking a sweat too much. There's a house built in the 70s.
Right. So after you've got some little bit credit card debt. No, that's nothing. That's only $600. Kind of early this morning.
That's essentially the recurring payments that I have that I'm paying off every month.
Yeah, that's nothing. So you're basically able to save what about like 50 to 80,000 a year about? How much do you figure?
I did it at the monthly level, but yeah, I'm conservatively saying about 5,000 a month.
Right. Now, whether that really
560.
happens or that's just theoretical, I mean, that's kind of my problem. I mean,
Agreed.
theoretically, it's very similar, but it's I was checking the other day. You can go to one of your credit cards, the one I use for all of my travel, and I was like, whoa, I didn't realize I spent that much money on that kind of stuff. The categories must be off, but
Right.
and that's what I'm gonna blame it on. But so you're at this level in terms of, I don't know if I call it acceleration or velocity, but if you're able to put away 50 grand every year in savings, it's just a matter of putting it in the right things, and you'll be financially free in the next like half a decade if you keep doing that. It's just
Yeah, it's the plan.
so yeah, let's what was kind of the first step that you kind of went to what was the first game plan here?
First game plan was during downtime at work, hit bigger pockets, start listening to podcasts that were actually on YouTube, started running numbers, started looking at different turnkey providers, flew down to Memphis, toured a couple different ones, picked one. It's been performing pretty well. I mean, it's not a theoretical thing in my mind anymore, but the limitation there was really just scalability. In order to replace my W-2 income, I'm going to need like 50 of these things in order to be able to make that happen, while accounting for vacancies and capex and repairs and all that stuff. So that's tough. That's a lot of money, and I'm sure there are other options that are available that can accelerate that timeline quicker and be a more efficient use of cash, while having these turnkeys as a backup for when there are no opportunities and I have excess money. Just go pick up another one of these things. But in terms of a primary strategy, I'm not sure if this is the way to go or not.
Yeah, and that property was what was the purchase price and the market rents for that one?
Purchase price was 108. Rents were 925.
So not the 1% rent to value ratio, but I
Nope.
mean, I think for you, I mean that one's kind of a perfect prototype, right? Like it's not a piece of junk that rents for less than $800. I mean,
Yeah, prototype's a good way to put it. I mean, that's kind of what I was looking for, was proof of concept. Okay, does that work? Then push all the chips forward.
right. And I believe you went through one of these more notable turnkey providers that are a little more expensive. So I mean, I don't have any problem
Yep.
with that. I mean, you make enough income where you can kind of just, time is more important thing. And I liked how you just kind of went in and got one. And you can't believe how many guys I talk to. They make pretty good salaries like yourself, but then they waste all this time. And I always tell people, for every 30 grand you have lying around, you're just losing $200-300 of cash flow, not including tax benefits, mortgage pay down, and appreciation every month.
Right.
So
Yeah, it's definitely right, correct. If my wife was here, she would give you a counter argument to that whole wasting time and talking it over thing. But yeah, we did eventually pull the trigger. The thing that really snuck up on me with the turnkey properties that I should have realized was, after the first year, the rent increases, and I did the math for that. I'm like, oh my God, this is an extra 3% cash on cash return that I hadn't even thought about yet. So talking to time, getting in there early and getting stuff bought quickly and responsibly is, you can play that time card and really, really dig yourself out if you buy wrong.
right. I think it's just also, that was a smaller sample size. A lot of what I saw was my taxes went up on the individual properties, as they should, right? Because the values go up, and that kind of ate that extra profit right away.
True.
But yeah, so you have proof of concept. How long ago was that?
Oh, I've had it for a year and a quarter now.
Yeah, so it was pretty smooth sailing, that one. I would say most
Yeah.
turnkey owners, it takes them a few months, or it's smooth sailing, or one every four will take them like 6 months to get going, and there'll be some kind of issue that pops up.
Yeah, I've been lucky so far.
So at what point did you start to realize, like, it was like, well, this is cool, but then ...
So I worked really, really, really early in the morning, and I had about an hour before anybody else got in. So I do my checks, make sure everything's good to go, and then I just start hitting up Excel and Visio and daydreaming basically, and just doing math with I had one guy, one coworker who was really still is really big into 401ks and deferred income and REITs and mutual funds and all that stuff. And he's talking about the amount of money he's going to need. So I've, of course, was trying to juxtapose that against real estate and other types of cash flow investing. And it came up that you'd need roughly around 350, 400 grand to do the turnkey properties to get to the point where it would be replacing my actual income. Wrote a PowerShell script actually to determine the acceleration in that loop. So, you're technically adding 250 every month, roughly. How much can you, or how much quickly does each turnkey property add to the time it takes to get the next turnkey property, if that makes sense. Like if it takes you a year to accrue amount of money to get from 0 turnkey properties to 1, then from 1 to 2 is like 10 months. And then, it accelerates past there. So I wrote some scripts that did that. And it was cool to see, but I was still coming up with like 8 or 9 years. And that kind of stinks.
And how many turnkeys did you figure that was?
It was high 40s. It was like 47, 48, something like that. And just thinking about, okay, you either have this many properties with one turnkey provider to keep your management headaches down, which is that's an insane vulnerability, or you split it out and have 3 to 5 properties with various providers in various markets and stuff, and then that still becomes a management headache because good luck keeping track of all that stuff. It's not very passive.
Right. So, I mean, what at this point did you you had some liquidity, right? I mean, you have a bunch of liquidity from your W-2 job, but were you looking at your 401k to take? Was that an option?
I looked at that. Actually, when we spoke last time, I had about 40 grand in the 401k, and I wound up cashing that out in tax year 2019. So that's kind of my war chest right now.
Hey, good for you. Yeah. Maybe we can kind of rehash that for the folks here. What was kind of your thought process there? And then I think we've probably talked a little bit about the taxes and implications.
Yeah. Well, the fees and taxes were really, that was my sticking point. It was scary to think, oh my God, I'm going to be paying extra money. I'm going to have this massive tax bill at the end of the year. But taking a step back and thinking about it in terms of, okay, 40 grand is a turnkey property and a half-ish. So what's my opportunity cost by not cashing that out now and then being subject to all the limitations of having a self-directed 401k with the, a lot of fees
and all this stuff.
Exactly. Yeah. It was such a headache, and being limited with what you could and couldn't purchase with it, just not having raw access to that money to do with what you want. And then getting nickel and dime to death in terms of fees. So even if I just took that money and threw it into a turnkey property, it would essentially cover the tax penalties, or the taxes and penalties within 2 years. And then you're break even, and then you're just free, and you don't have to worry about maintaining another account or, what are the legal implications of all this, stuff. It's just money that you have available and working for you. So looking at it that way kind of pushed me over the hump towards cashing it out. It was a little scary, but so far it's been working out.
Yeah, most times, the cashing out your 401k to do this is seen as like naughty, right? People like, oh, that's your retirement.
Yeah, I didn't tell anybody at work about that.
Yeah, I mean, people are going to think you're crazy, but let's kind of walk through this for the folks listening. You're going to take out your 401k, go into income, so you're going to get taxed on it, but you're going to get taxed on it anyway. So the argument there is, in my opinion, the taxes will be probably higher in the future to pay for all this quantitative easing that we had in 2008 and all these bailouts. And, hopefully Patrick's income is a lot more higher in the future, which is counterintuitive to people who think when you retire, your tax bracket will go down. We plan to get richer as we grow older.
That was a big paradigm shift for me. Yeah.
Yeah. And then, the 10% penalty. I mean, it's unfortunate they call it a penalty. They should call it like a ticket to the big dance. But, it's just a math equation. And I like how, you're very, I don't go as far as writing scripts and stuff like that, but you got to figure out that break-even point. And what you said, Patrick, is very good frame to analyze anything you're going to do, right? I always say that numbers, don't follow the numbers, but it's, to make decisions simplistically, don't figure out how much this is going to be, how much this is going to be. Compare the two scenarios and just see where the numbers fall.
Yeah.
It's simple. Compare scenario A, compare scenario B, and go with the best.
Yeah, it's freeing. It's emotionless. You don't get wrapped up in it that way. It's just cut and dry.
Yeah, and I guess that was a good move for your situation. But I would say for some of these other guys, they got like $200,000 to $500,000 in their 401k. Now that's where we have to get a little bit more use a little more finesse. We can't just take that all out once, because that's going to blow up your AGI, and you're going to probably get taxed 50 cents on every dollar on that. Where I think, Patrick, you aren't getting killed too much by the IRS, right? I think you're probably in
I suppose it's relative, but
yeah,
yeah.
You're getting 1/3 of your bacon chopped off there instead of half of it. So it wasn't
It could definitely be worse.
Yeah. So yeah, what's the next move now? I mean, are we kind of in kind of a steady state here, just going out getting properties, or what's next for you?
So I like turnkeys as a base. Get it like 5, 10 of them, something like that. Probably with the same turnkey provider, maybe in different geographic markets if the provider offers that. The one that I'm looking at does. So that kind of mitigates your risk a little bit, but I would view that as kind of the safety net going forward, the slow, steady, predictable income. But as far as scaling that up to the full 50 to completely replace W-2 income, I don't see that as a really viable or desirable approach. So things that I've been looking at are some types of syndication. Again, I've tried the DIY aspect and realized how bad I am at that. So that's off the table at least.
What did
Really,
you like about that specifically?
I really hope my brother doesn't watch this, but I love the guy. It was the property's 2.5 hours away from me, so that stinks. You drive up there, you're already not at 100%. It is a 100-year-old property. Everything that could possibly be wrong with it is wrong with it. Like, we just discovered that the main vent pipe for the entire property is perforated, completely perforated. So the entire thing needs to be replaced, which means ripping out a bunch of drywall, which means running new plumbing, which means redoing the paint and everything. I mean, and then getting a boot on the roof to run that thing out through the roof. So just a lot of things like that just come up in these old properties. And because it was our first one, our budget for it was a little bit off. We're coming out of pocket. That's not the end of the world. It's a big learning experience, and if I had it to do again, I would just do things differently, and that's called learning. But for now, it's just kind of an albatross on my neck until it's done.
Yeah, and this is this Hannah Street one that you guys are working on.
Oh, no, that's the turnkey one. If you scroll down to the partial ownership.
Oh, okay. Okay.
Yeah, that's it.
Okay. So this is that little what's the, have you sold this property, or are you still working on it?
We're still working on it. Our schedule is to have it rent ready by April 1st.
So this is what's the exit strategy? Is it just a rental, or is it just a flip?
It's a rental for now, and it's weird that you asked that, because the contractors that have been coming in to replace the windows and do all that stuff, they all ask us, "Oh, are you flipping this thing?" And when we tell them, "No, we're renting," they're like, "What? Really?" So that doesn't make me feel super good. But yeah, our plan is to rent it for 5 years or so, until we have some equity built up, and then dump it and move on.
Why not sell it now? What's the difference that those 5 years is going to do?
So in my mind, appreciation up there is not existent. So it would be more equity pay down. In terms of why not sell it now, I'm open to that. I'm definitely not married to the long-term rental strategy. Just the right offer has to come along.
Right. I mean, I mean, you know all the charts and how mortgage pay down happens, right? It's non-existent the first year or 2 years.
Yeah.
I mean, that's what's happening.
Yeah.
But no problem just keeping a tenant in there. But then here's the predicament that I'm having with all my turnkey rentals. You got a tenant there, now you can't get that pop in price, right? That you
I'm
can't
not
have
sure.
a new home buyer come in and say, wow, I love this place, where they can't even get in. You got some people, all their
Oh,
properties all over the place.
yeah, yeah, I gotcha.
So, and then what I believe is, when people are coming here and renting, they screw up these properties. I mean, make no mistake, you're probably gonna have to put another 10 grand in there to get it rent ready, or not rent ready, but retail ready.
Hmm.
It's kind of like that who's that Peanuts character, that really dirty kid.
Oh, Pigpen, yeah.
Yeah, he's there for like 5 minutes, but he screws it all up. It's kind of like what they're gonna do with that property.
Yeah, yeah, it's true.
But yeah, if the numbers aren't there, I mean, you got to just hold on to it, I guess.
That's kind of our worst case. And if
Yeah.
that's the worst case, okay. As long as it covers its mortgage, I'm not disappointed in it, I guess.
Yeah. I mean, it's, I think what I see a lot of people and a lot of investors, and why I tell you guys to get single family homes first, or even try something like this, is see if you like it. If it doesn't really resonate with you, just, run away.
Yeah,
Life's too short to be doing things you don't really like,
yeah.
especially when you can just go and get turnkeys, right? In your sleep.
Yeah, I mean, you were talking about running different scenarios. I have done that, looked at all the time, energy, and raw capital that I've put into this Harrisburg place versus how many turnkeys I could have gotten for that, and I could have gotten many.
Yeah, right.
um, yeah, again, it wasn't the best financial move so far, but it was a learning experience, and it's definitely crossed something off the list for me in terms of avenues I can pursue.
Right. And I think, I don't know what exactly you were doing here, but people do that with, they think the burst strategy is one of the coolest things.
Yep.
But sometimes you've got to run the scenario. If you would have just done the slow and steady, the turtle route, and just picked up turnkeys with that money, as opposed to, you know, instead of buying two or three off the bat, you bought one and you had all your money in there. It took forever to refinance, and how long that took, and life energy away.
Yeah. Yeah. No kidding.
So I'm looking at the primary residence there. There looks to be some equity there.
Hmm.
There might be some opportunity to get some cash out of that. I know you probably think that this 3.25% interest rate is pretty sweet, which it is, but it's not. You don't want to look at it like that. That's how unsophisticated investors look. They look at interest rate and the amount of debt.
Hmm.
Sophisticated investors look at what we would have done with this equity. You could probably take out like maybe like 80 grand via HELOC or something like that, and you could have
Yep.
bought two or three turnkeys or whatever.
Yeah. So I do have a HELOC out. I've got about 50 grand available in it now. And then I've got some life insurance coming due that I should be able to leverage into further turnkey properties. The plan with the primary residence, so I'm very close to a military base here. And the thought was to rent this place out and just kind of, move on. We have a lot of people that get stationed here for 2 years, families, and it's tough for them to buy every 2 years. So they're a pretty much guaranteed rental market.
Yeah. Okay. Cool. Let's talk about that. So the purchase price on this thing is about 400 today. How much have you
Yep.
run comps, and what do you think you're going to be able to rent this thing out for?
So we had last year we had somebody come out and tell us what the rental comps were, and actually there's a place down the road that's renting out. They're renting for 2,500, so it's pretty sweet. If I could even get 2,250 or 2 grand even, I'd be happy with that.
Yeah. I mean, I guess what I'm saying is, like, if it's not getting you near the 1% rent to value ratio like your turnkeys are, run the numbers, right?
Uh,
Or, run the scenario. If you would have took the equity, if you would have just sold the whole dang thing,
mhm.
taking the 150,000 or $140,000, well, probably on 120 after commissions and taxes. But if you took the
Yeah,
120 and you bought one, two, three, four turnkeys, how much would that produce
that's interesting. Okay,
versus renting this thing out at 2,500 or whatever?
right, like 0.5% basically. Yeah.
Yeah.
Huh.
And like you said, if I think you mentioned where you're at, it just doesn't appreciate too well where you're at. So why the heck would you do this?
Yeah, I'm gonna have to run some numbers on that. That's that's an interesting thought.
Yeah, I mean, it's just like, when you're getting the turnkeys, right? You bought like a kind of a minus class turnkey, I
Yeah,
think. And
yeah, it was pricey.
yeah, and as you go up on the scale, maybe 120, $150,000, you see your return peter off, right?
Yep.
The rent to value ratios are not linear. They kind of peter off at this point. This is an extreme case of that.
Right, I gotcha. Yeah,
$400,000 buys you, um, I don't know, only $2,500 of rent.
right.
So something to think about. I mean, I
Huh.
would say, yeah, maybe you can keep it if you're in like, more of a high appreciation area in California, parts of California,
Yeah,
for
we'll see what
example.
Amazon does. We're pretty close, less than an hour away from that, so we'll see.
Yeah, that might be, that's a story, right? I mean, I can get behind that, you
Yeah,
know, but
I'm gonna
then
run the
again,
numbers either way. I mean, why wouldn't I?
yeah,
That's something I hadn't thought of before.
and so run the numbers like this. Do like two scenarios, like run it with, um, the sort of what you think is going to happen. Maybe the price sort of goes up 3%, 4% every year,
Mm,
but then run it where the numbers go up like 6% every year, right? The optimistic. Because the syndication, some syndication deals, what I like to see is like, hey, run the numbers where it's pessimistic, optimistic, and like, kind of pro forma, just
okay.
to get a ban. Um, but yeah, in that case, you never really get to see the back end, like what assumptions they're using. So it's completely garbage. But you're the one doing all the assumptions here, so you
Right,
can
right, right.
actually trust it. And then just ask yourself, right? Like, look at the pro forma. Is this worth it? Well, obviously it's not, right? We're saying that. But
Yeah,
the optimistic scenario, is this really, we want to play this type of game? And I don't know. I mean, you might be onto something there. I just don't know. But
maybe. I mean, to play devil's advocate, with what you were talking about with the time factor, how many years is that going to be before they even break ground? Until they're finished, until that appreciation happens, and what you have done with that extra equity during that time frame, and then is it worth it? So I'm
right.
definitely going to run numbers on that. That's a really, really good point. And so what would how so okay. So if we do this, sell this, and then what? Just wind up renting, essentially?
Yeah, I mean, that's what I recommend doing. That's
Okay.
what I do, especially for people in primary, um, more primary markets.
Hmm.
But maybe you go and you get back into the the normal working class range of like under $250,000. You buy something like that.
Yeah, that would be a 2-bedroom condo around here.
Yeah, I mean, you may not want to do that. You're kind of too old for that kind of stuff.
Yeah, I am cheap. We'll see.
Yeah, we'll
See,
see.
that's a talk with the boss.
Yeah. I, yeah, you kind of mentioned yeah, just try run the numbers on this and see what it works out as.
Yeah, that's a really good idea. To go back to the physics equation, that could be the hidden mass that I wasn't taking advantage of.
Yeah, I mean, you're constantly trying to look for equity that pops up, and when I kind of look at these personal financial sheets, I just look for low hanging fruit. You know,
Yeah.
so systematic, and look at the 401k money, and then the equity in your house. Um, yeah, I mean, take a look at that article, simplepassivecashflow.com/home. Um, just kind of get your head wrapped around like, not owning your home, renting it more.
Okay.
And then here's kind of a kicker too, right? Like, I mean, I believe a recession is coming up in the next 1 to 3 years.
Yeah.
I mean,
Me
so
too.
many indicators are kind of pointing that way. What do you think this $400,000 house will drop down to sort of overnight,
That's a good question.
right? I mean,
Yeah.
I know how you are. I mean, you get people who have money they work off fear. So I just scared you to do
A little
something,
bit.
right? I mean, people have money. It's very, very simple. People have money work off fear. People who don't have money work off hope. Right? So like the whole
Yeah,
optimistic strategy may not work on you these days. You may
right.
be more compelled to hedge your bets than to go after that optimistic scenario that you're going to go after. Or
I think that's one of the things that Harrisburg has taught me too. Yeah. Slow and steady wins this race for sure.
yeah, and here's another thought. This is definitely more like wine cooler time talk. It's not no theory, no data really built behind it. But like if you're familiar with like Austin, right? The city of Austin, Texas, how it's
Yeah.
kind of blown up.
Mhm.
Very similar tech town or tech story behind it. But when Austin was like, just didn't do very much initially when Dell went in there, I think in the 1980s, 1990s.
Okay.
It took them like 20 years for it to get to this point today. So the whole Amazon thing, they're going in and there's obviously an initial bump, but to get that huge appreciation that Austin has seen, it took like couple decades for it to happen. So it
Yeah,
may
it's a
not
good
be,
point too.
but I'm also the guy who lived in Seattle for 14 years, and wow, like Amazon just kind of changed that city for sure. So I don't know.
Yeah. Well, we'll see what the numbers say.
Yeah, yeah,
That's a good avenue, though. I hadn't even thought about going down that road.
yeah. But yeah, anything off the top of your head? I mean, I think you're at this mode where, your net worth is about 160. You, you're eating some rice and beans. Maybe you can kind of lighten up a little bit and kind of live life a little bit. You'll get there. It's just going to take time.
Yeah.
I
Yeah.
think once you start to hit, yeah, I mean, I guess the first 100 is always the hardest part, but man, once you start to hit like 400, 500, man, that's when things really start to take off, I think.
You're talking about net worth?
Hmm.
Okay. Yeah, that makes sense. I mean, yeah, I mean, it's the acceleration curve again at that point.
Right.
So aside from turnkeys, though, and aside from turnkeys and syndications, is there any other sector, for lack of a better word, that I should look into to kind of broaden my horizons and diversify a little bit? I'm already doing the whole life insurance. My war chest essentially is sitting in AHP. Um, I'm trying to start turning out some of these turnkeys, and then once I can put 50 grand together with a little bit of extra cushion on top of it, I'm going to start throwing some money into syndication. So is there any other type of sector or strategy that you're aware of that I should do some more research on?
I'm not. I
Okay,
mean, I'm sure there's ways of, making an active business, but
sure.
I mean, you seem to be pretty busy at your day job. You're not in a very good location to be being the operator.
Yeah, no,
And this is kind of where we look at like your skill sets to go find deals, right? And I think that's
okay,
the
right.
biggest thing. You got to go find the deal. And people ask me all the time, well, how do I get in? I want to get in the general partnership. And I'm like, well, you didn't do anything, the heck, how the hell do we want you in a general partnership for, right?
Right.
I mean, if real estate or syndications is like where you want to excel, you've got to do something to add value, right? Or this is where you kind of jump from, $100,000 net worth to $1 million net worth sort of overnight. You got to make a business, right? That uses your skills.
Right.
That's a different realm. I personally don't do that. I just invest passively.
Yeah, that's what I'm looking to do as well.
Right? Like I grow my money at 20 to 30% every year, but nothing explosive like a business can, like at 50, 100, 200% a year.
Right.
And I think that's how you like transform yourself into, um, you playing the rabbit game. You just zip right up there in terms of net worth. But I'm not the guy for that. I mean,
Yeah.
I'm sort of playing around now. Now that I have a little bit more free time, or not free time, but kind of instead of hitting singles, I'm kind of looking to hit more home runs. I'm kind of looking at like buying websites and adding value via content marketing, or maybe making a podcast with that, or doing something like that, right, that I'm interested in too.
Right. Yeah,
But
but that's borderline business at that point. Yeah.
right. But that's like the next frontier, to answer your question.
Right. Yeah, that makes sense.
You can
I mean,
play around with things like Tradelines that can get you an extra 10 grand a month. But I think you're
yeah,
redlining it with, I mean, you're making a pretty dang good salary. I mean, most people dream about being able to save 50 grand a year.
yeah, no, you're right. And that's kind of what initially started me off on this is, oh my God, I've got this great opportunity. I don't want to screw this up. I don't want to squander this and waste this. The salary, it's not like it's going to go away in 5 years. I'm good at my job, but I don't want to waste the opportunity,
Yeah.
to do something more.
How is the job? Is it pretty taxing, or is it, well,
Um, from a technical standpoint, it's not. From a micromanagement standpoint, it is. From Office Space, the guy Peter has like 6 different bosses or whatever. That's basically what I have. And the door does literally shock me every time I walk in. So I got it all.
so in terms of time though, is it pretty, it's like
Oh
40 hours a week, 50 hours a
yeah,
week?
40 hours a week.
Okay. So you can't complain too much, right? I guess.
Exactly.
Yeah. I mean, I would say, this is kind of just a more of a finesse thing, but hey, you're right. You're in cruise control. You're going to get there in time. Just, I don't know, chill out a little bit, maybe buy a little bit better rice,
Right.
swap out the
Basmati.
beans,
Yeah.
swap out the beans a little bit. And then, when you run your calcs, figure out like, hey, you may not get there when you're like 40, or you'll get there when they're 40, right? But then the question is like, when do you really, like, when is it acceptable to get there, and kind of titrate your life up to that kind of higher standard now, because you never know when it's all going to end.
That's a good point too. Yeah.
So that's when you kind of put on, because right now you have the scarcity mindset right now. So you got to
Yeah, I'd agree with that.
transition more towards the abundance mindset, and whether you have $100 to your name, $160,000 to your name, or $250,000, or $250 million. At the end of the day, it's more about having that more abundance mindset, which sounds corny, but you don't really get the abundance mindset unless you have money. I mean, I don't care what people say. You can sit around and sing kumbaya and hold hands around the campfire. It ain't gonna happen unless you got some cash.
Yeah, so that statement can be broken out. The scarcity and abundance mindset can really be broken out into its own complete discussion. And I'm starting to see some of the different shadings to that discussion as I'm kind of going through the journey here. Commas in money don't seem to matter as much in certain things anymore, and I think that's part of that transition. But you're right, it's definitely easier said than done.
Right. Where you are, net worth is kind of where you are.
Mhm.
The fact that you're saving $50,000 a year, that's kind of your speed that you're going, your velocity.
Yeah.
So maybe it doesn't matter where you are in terms of net worth, but as long as you're zipping along at $50,000 a year in terms of speed, maybe that's all that really matters. That you have the mindset that you're going to be okay, that it's just going to take a few more years, and then that carrot is right there. That's
Right.
just another way of thinking about it.
Yeah.
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 But any other questions before we wrap this up? And
No, not at this point. Not at this
yeah,
point. Do you have any
yeah.
other
I
questions
mean,
for me or anything?
just that's the way I see it. Just kind of just keep zipping along at $50,000 a year, and we'll get there.
Yeah.
Yeah, I would say from here on out. I mean, the turnkey rentals thing, you've pretty much got that hammered down. Maybe if you're still going to pick up single family homes, work on more on getting the brokers and the deals yourself, so you can save a little bit there. And then on the syndication
Yeah.
side is a very like big pivot, right? Like, and it took me a while to buy anything or to put money down to feel comfortable. The
Mhm.
game switches from talking to vendors and stuff like that, and networking with other passive investors.
Okay.
So that's when kind of the network is really your net worth, when you kind of switch to that 2.0 level.
Right. I gotcha.
Yeah,
Yeah, that'll be fun.
yeah. Because I mean, the people that are more accessible, I wouldn't particularly say you actually want to work with them. They're just good marketers.
Yeah. Yeah, that makes logical sense. Yeah.
But cool. Yeah. Thanks for doing this, Patrick.
Sure. I hope someone gets some value out of it. I definitely have. So thank you for offering it.
Yeah, yeah. And I will I guess what's the call to action today? I guess go join the investor club, simplepassivecashflow.com/club. And we mentioned that slash home article. That's another good one to kind of
Yeah.
read up. And yeah, we'll talk to you guys next time. Thanks, Patrick.
Thank you.